2022 has been a highly volatile year for the market so far, with major indexes all pulling back into correction territory and flirting with bear market conditions. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the professional traders at our firm are trained to understand how their playbook changes when the market gets this volatile and which options trading opportunities in these kinds of conditions are optimal. In today's video, we will be sharing with you an easy to understand strategy that most traders don't even think about when market conditions get this volatile, yet huge opportunities open up if you understand how options work. So if that sounds like something you'd like to learn, then stick around. This is going to open up a whole new way for you to trade in volatile markets like the one we're experiencing right now. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so this year has started off pretty rough, as you all know, with the market pulling back dramatically from the 1-2 punch of runaway inflation that the Fed's going to be fighting aggressively, combined with Russia's invasion of the Ukraine and the massive geopolitical implications of that. And so the market's rattled, which can be seen in a number of ways, one of which, of course, is the price of the S&P 500 index, which has dropped 10% into correction territory since it reached its all-time highs earlier this year. And when you have these kinds of volatility-inducing factors in the market, another way of determining that you're in a volatile market is by taking a look at what is known as the VIX index, which measures how much fear is in the market based upon traders and institutions pushing up the prices on options contracts to protect their equity holdings. A reading of 30 is considered to be very elevated, and the VIX has lived above 30 for a considerable amount of time in 2022. And when these kinds of volatility conditions are present in the market, it gives rise to lots of trading opportunities in the options market, which many traders are not aware of. Now, before we get into the details of one particular option strategy that sets up beautifully in a market like this, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, click the link that should be appearing now at the top right corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. Okay, so to explain how this volatile market option strategy works, we need to make sure that everyone watching the video understands how index options work. So we're going to go through a really quick review of them, and those of you familiar with them, just hang in there. This is going to be really quick, and we'll jump right back into the volatile markets option strategy. All right, so the best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless, as the index didn't close above 40.75, so the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75. But the 4,000 puts, those would expire worthless because the markets didn't close below the 4,000 strike price. Okay, so with that in mind, now why do I say that a huge opportunity exists in these volatile times? Well, let me draw a contrast for you to drive home the point of this opportunity. So let's go back to a time that was not volatile like today's environment. So for example, if you went back to November of 2017, you'd see that the VIX had actually fallen below 10, which is considered a very low volatility environment. And that's not surprising as the market had been grinding upwards all year, as you can see, having reached 25.75 by November 2nd of that year. And so let's say that during that low volatility time, you took a look at an options chain 51 days out in the future, a little more than 7 weeks out. And with this SPX trading at 25.75, let's suppose that you sold 10 of those 26.60 calls less than 85 points above the market price. And you also sold 10 of the 24.10 calls about 165 points below the market. Then you simultaneously bought 10 of the 26.80 calls at a strike price 20 points above the 10 we sold for protection, and also bought 10 of the 23.90 puts 20 points below the ones we sold, again for protection. Well, if we did that, that entire combination, short calls and puts bracketing the market and long calls and puts protecting those short positions farther from the market, that entire combination of 4 options positions in this formation is what an options trader refers to as an iron condor. And this iron condor is considered to be 250 points wide because the short calls and the short puts, the ones we sold bracketing the market, the strike price of those options are 250 points away from each other, with the puts down at 24.10 and the calls up at 26.60. Now, you may be wondering, why did we pick these particular strike prices? And the answer is that options traders focus on a particular metric known as an options delta, which is basically a modeled prediction of how much the price of an option will move for every 1 point that the index moves. But the delta also happens to be correlated fairly closely to the statistical probability that the index, in this case the SPX index, will close beyond the strike price of the option on the day that the option expires. So in other words, statistically, there's only a 10% chance that the index will close above 26.60 51 days later, and also a 10% chance that the index will close below 24.10 51 days later. And so a 10 delta iron condor means that both the short calls and the short puts each have a 10% chance of expiring worthless. Why? Well, think about it. If the SPX closes below 26.60 and anywhere above 24.10, and there's a 10% chance of either of those things happening, then all 4 options expire worthless. Why? Well, remember, the call options only pay off if the index closes above their strike prices, and the puts only pay off if the market closes below their strike prices. And so if SPX closes anywhere in that range between the 2 prices, then all 4 expire worthless. Now, you might be asking, why would we want to enter into an options trade where the options all expire worthless? And the answer lies in the cash flow of what happened when you first entered into the trade. You see, when you entered the trade, you sold the 26.60 calls for $3.40. But remember, each point that SPX closes above 26.60, those options pay off $100 per point. So you multiply that price by 100, and you sold 10 of them. So when you multiply it all out, you received $3,400 for the calls you sold. But then you turn around and buy the 26.80 protective calls, and those cost you $1,970, as you can see. You also received $7,400 for the 10 puts at 24.10 that you sold, and then you paid out $6,400 to protect them with the 23.90 puts. And so the full calculation shows that you actually received $2,430 in cash that went directly into your account the day you entered the trade. And so here's the thing. If all 4 options expire worthless because the market closed between the calls and the puts, then you still get to keep your initial cash of $2,430. And so that's how you win an iron condor trade. When the market closes between the short calls and the short puts on the day the options expire, you make that initial cash flow. So if you think about it, the wider the distance between the short calls, the better, because the chances of the market closing between them is that much more likely. Okay, so now that you understand how you win on an iron condor, let's take a look at the last time that the VIX got over 30 like it is today. You see, back in December of 2021, towards the end of November, the market began to sell off and continued to sell off until December 1st with a big red down candle that day, which pushed the VIX over 30. Well, as we said earlier, the VIX being that high is unusual and indicates a high degree of fear in the market. And so let's take a look at what would have happened had we entered into, again, a 51-day iron condor on the SPX, just like before, using, again, the 10 delta criterion that we used on the 2017 condor that we just illustrated. And as you can see, whereas before the iron condor back in 2017 was 250 points wide, in this volatile condition on December 1st of last year, the 10 delta iron condor was 1,000 points wide, with the short calls up at 48.90 and the short puts down at 38.90. Now remember, the iron condor wins when the market closes between the short calls and the short puts. Well, back on that date, you'd have to go back to March 8th, 8 months earlier, to the last time that the market got down to 38.90, where the short puts are located. And on the upside, the SPX index has never to this day hit 48.90, where the short calls are. And so while conditions are pretty crazy at this point, it seems really unlikely that the market will not close in that 1,000 point range between 38.90 and 48.90. Additionally, we need to look at the cash flow of this high volatility iron condor. And as you can see, the condor yields $2,850 of positive cash flow, even though the iron condor is exactly 4 times wider than the example we showed you in 2017, which had only a 250 point width. Yet we have a much wider landing zone for profit in this case, and $400 more profit potential. And so it shouldn't then be too surprising that when we move to January 21st, the date that these options are valued for settlement, as you can see, the market opened up at 44.71, which is the basis upon which SPX options expiring that day are going to be settled. And so let's see exactly what that meant for our trade. And as you can see, since the 48.90 and the 49.10 calls expired way above that price, and the 38.90 and 38.70 puts expired way below that price, then all 4 options expire worthless, and the trader just walks away with that initial $2,850 for setting up a trade that wins as long as the market stays inside a 1,000 point range on an index where 1,000 points represents more than 20% of the entire index. In other words, it's really probable that the trade will make money, as common sense would tell you. And so what I'd like you to take away from today's video is that high volatility times present wonderful trading opportunities for professional traders because they understand what happens to deltas when the market volatility picks up. They spread out so that 10 deltas in a low volatility environment creates a small zone within which a win can be had, whereas in high volatility times you get these gigantic zones of potential profit on an iron condor, giving you in many cases more reward for a trade with a much wider zone to take home all of the original cash that you collected. Those kinds of opportunities don't come along every day, and professional traders know that they need to take advantage of them. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.